All right, it's Grant Abbott speaking. I've got Michael Jeffries, our CFO, and also super huge brain when it comes around to our companies and all accounting stuff. So, hi there, Michael. How are you?
Hi, Grant. I'm good.
Good. Just as I go through today, if you want to pop in, put your 2 cents worth in at any point in time, and I've got Mr. Tony Anamoulis in there as well. How are you, Tony? You
Hey, how are you all? Good.
okay? That's good. He's obviously had his coffee.
I've
Only
had a
you've had,
coffee and I've had a coffee and a ciggy. I
I
have.
know you've only got six more weeks of lockdown, you poor bastard. So,
Unbelievable, mate.
anyway,
Yeah.
it's interesting. So hopefully they're going to open up the borders here. I think Palaszczuk is probably she's realised they've spent 500 grand on COVID, not COVID actually itself, just COVID marketing or doing sample testing, etc. So to do a whole lot of polling, and apparently leaving the borders unopened is very much on the nose, and she's well and truly under the pulse, so she's under the pump. So expect the borders in Queensland to be open very shortly, guys. I can imagine that. Anyway, notwithstanding that, what I thought I'd do is with this session, we did advanced healthcare directives for South Australia last week, and for those of you who went to the session, look, it's a great product, absolutely crucial, and I went through my situation with my father, which made a huge difference to our family having that advanced healthcare directive. And so it's absolutely crucial for basically everyone in the family. It wouldn't matter what, obviously, if they're under 18, the parents have the say anyway, but anyone over 18 is really crucial. And for those who are of a particular faith, there's obviously requirements about what you can and cannot do. So I was going to roll out the advanced healthcare directive for all the other states, territories, but I'll be doing that next Thursday. I've just had like two or three issues that have come up in the last couple of weeks. I know Tony's going to have a chat a little bit later on when it comes around to putting the right things on the contract for sale. So that's absolutely crucial because he's seen, in fact, we've both witnessed a lot of rubbish coming through from the various advisory magazines on what should and shouldn't be done. And you've got to be really careful there because potentially it can end up costing you quite a lot in double stamp duty. So we'll look at that a bit later on. But what I thought I'd do is we'll go through the law. We'll focus heavily on related party loans. We'll look at what's required to make a related party loan legal. And as I said, personally, from the ones I've reviewed, about 98% of them are basically either wrong or downright illegal because they miss a number of steps. It's very easy to just jump online and get a holding trust from anywhere, really. But I've seen people doing loan agreements by way of a minute, which just doesn't make sense. It was funny actually. The rental reduction. I think there was an article in the I think the SMSF Advisor about the importance of having rental reduction agreements, and we had a few people come up and said, well, do you have any minutes? And look, a minute doesn't do anything. It's rubbish because if you've got an existing commercial lease, you need to put a rental reduction agreement that fits in specifically with that lease. Otherwise, it's null and void. And obviously then that creates non-arm's length issues, Section 62 sole purpose test, and of course, gnarly issues. So you've got to be extremely careful of that one, which is why 3 days after the Commonwealth Government instituted its business compact around commercial leasing, we had a rental reduction agreement online that takes 5 to 10 minutes that fits in over the top of any lease agreement. So utilise that rather than a minute. So again, I would say probably about 98% of rental reduction agreements in Australia are currently wrong. But that's what we hear. Tony, Michael, and myself, we all go through and say what's required, what's the process, what are the exact documents that are needed, and how is it to be done. And then if we can, we automate it. Anyway, let's go around. I mean, LRBAs have been around. In fact, they were around prior to 2007. There were a couple of parties doing it then, and they were doing quite successfully. But then in 2007, when the government introduced Simpler Super, they brought into play Section 67(4)(a) of the CIS Act, which enabled borrowings. And there was no single acquirable property then. You can just do it over any property. So all the big banks got in. Look, it was a really held for leather there for a while, and probably not the best time to introduce it, given the GFC. But by 2010, they tweaked it a little bit, and that's where we've ended up with Section 67(a), which has been robust. I mean, they've been talking about it so many times. This Senate committee says this. You know, the Labor Party is going to get in and they're going to knock it on its head. Industry funds are forever bleeding about it, but I love to see Host Plus have, had huge problems now with people removing money from their fund, which is good. So, I think we've got the LRBAs around for a while. The problem is the big banks have moved out of the space, which is it's bloody typical of them, isn't it, really? I mean, they're on the nose for everything, the banks, and enabled smaller banks. I don't think, what's it? Is it Judo Bank, Michael? I don't think they've come up with a product, but I know they are looking at it.
They've been looking in the space, but there's still, we've got access to a decent panel of, as you said, second tier lenders for using e-money. So.
Yeah, so for anyone who, again, one of the thematics that you're going to get out of this is we've seen a lot of things that have been mucked up and mixed up. So it's absolutely crucial before you do anything, contact us. I mean, that's part of your subscription is to contact us. Even if you're PAYG, just say, look, my client's looking at doing this, this, and this. What's the best way of doing it? Because you'll see as I go through, we could use a 1322C or a direct property. There's huge differences between the two. But in the instance, maybe if you want to put your details up on the chat line there, Michael, that in terms of going into e-money or somewhere else, just contact Michael is probably the best. So the big banks have moved out. You've obviously got La Trobe, Liberty, and there's a few others there as well. So they've sort of come in. It's funny, Gaydens was doing all Westpac and St. George, and now they've dropped down to do those. And I'll talk about that a little bit later on. Related party is one I want to look at today, and we'll have a look at how that fits in and how it's fixed. And then what we'll do is we'll take it from there. And essentially what we'll do is, I think it's either Michael or Tony, one of you has got a bit of noise in the background. If you might both want to mute and then just pop in and out when you can. So what we've got there is refinancing current LRBAs with borrowings, or alternatively what we can do there is we can be in a position that effectively from our perspective that we can even use deposits. And we've currently done one just recently where it was a settlement, or sorry, deposit was paid by the individual themselves, and effectively you had to go through and make that an LRBA up front. So we just got to be very careful. So the ATO has got to give an advice on what the process is. So we're going to go through the process. And again, I always, look, I find that, again, you've heard me say this a lot, but I prefer if the ATO's got a process and a strategy, follow that one, because then, because quite often what will happen coming down the track is that the auditors will poke their heads up and they'll say, oh, this isn't right, or that's not right, or you should do this. But then if you've said, well, it follows the ATO guidelines, then it's okay. So, for example, I had through John Grokey at Johnson Grokey over in Adelaide, they use the leading member structure quite a bit, and in particularly enduring powers of attorney to take control of a fund, where you could have, for example, one trustee or one corporate trustee looking after the whole fund, with all the members having given the enduring power of attorney. And for those of you who've seen our EPOA, there's a special box that allows that in the EPOA. It's the only one in Australia that does that. But they had an audit, a compliance audit from an AFSL perspective, And they said, well, you can't just use EPOAs for that. That's against the spirit and intent of self-managed super fund. So I just went in, got the Commissioner's guidelines on EPOA, looked at the first example, which talked about a couple who had their own self-managed super fund in Australia, went overseas, and they gave their accountant their EPOA, who took on the role as trustee for all the period of time that they were overseas. So that's an easy way to shut down auditors when the tax office comes out with guidelines like that. It's very, well, you can't really argue against the tax office, but if you do, I mean, it's up to them to go and argue the tax office is wrong, which they're very probably cognizant not of doing that. So let's look at bank and second tier lending, what's required, and make sure. I think the first thing is that when you do with the banks, you have to understand that the process is, and I'll get Tony in here in a second, that when you go through the process of using a second tier lender, particularly useful if you're using obviously Michael at eMoney, because what happens there is we can, they already know our documents and systems from that. But generally, if you go out, you'll find that companies like Gadens, etc., the legal firm, we all know it, which is one of the reasons that Abbott Morley is the legal firm that is there for accountants or planners. The very nature is, as soon as they get something, they know they can not. Well, they do. They'll just charge you $2,500 to $3,000 to review all deeds going back forever and at a time. They'll check the current deed. They'll check the current documentation as well. So if you're using any of those parties, the best thing to do is obviously make sure you upgrade your deed. So the deed should have the ability to obviously acquire the asset and even potentially have a run a business if need be, as per the ATO guidelines. I'll talk about that a little bit later on. But also when you do a holding trust, prior to executing it, sending it off to the lender so that the lender can have a look at it and authorise it. Because the last thing you want to do, we got in a round robin of rectifications that we did. A holding trust was executed. It came back from Gadens, who wanted to make some changes, which generally, look, I don't mind making changes to that, because then we'll change all of our precedents so it doesn't happen again. But as I said, they're gonna want changes anyway. I mean, it's the first time on that the holding trusts that we've had, for 10 or 12 years of that sort of thematic that has been required, but we made changes to that. Unfortunately, what happened is then it was executed and sent in again. And then Gadens wanted further changes. So we ended up rectifying a rectification, which was just a painful process. So it's absolutely crucial that when you go into this, to make sure that you do the right thing and you got the documents right online, which I'm going to have a look at. But are you there, Tony, at all?
Yeah, I am.
I just want to go through a couple of issues that we've faced, which is, honestly, we love you guys, but it's not the sort of work that we really want to go ahead with. So if we can preempt it and get things completed properly in the first time, in the first instance, then it's not an issue. But do you want to go round through, what should be on the contract, etc.?
Yeah. What happens is there was an article that I was, just before we get into that, there was an article that I was reading in one of the magazines, basically, and it said that along the lines that, quote, the conservative view is that the contract must be executed first before the holding trust, right? Now that's incorrect, okay? What should happen is that the holding trust should execute the document first, and then you should execute the contract, okay? Not the other way around. Otherwise, if you do it the other way around and the loan has been repaid at the end of it, and then you try to transfer that asset into the fund, from the holding trust into the fund, then you'll get a whack of double stamp duty, and that's painful, right?
I think there's been a case on that, hasn't there?
There's been a case on that in the New South Wales Court of Appeal, but we can get into that you know, a bit later on, because it's a little bit of a lengthy case, and what the judges have to say about it, you know.
But I think, I think also right from the outset is that when we get in, I'm going to show you Section 67A. We're just going to rip through that really quickly because it's fairly important. But Section 67A requires the asset to be acquired by way of a holding trust. So the problem is, if you acquire the asset, put the contract in the name of the superannuation fund first, then you can't finance it, because once it's in the super fund's name, it is then illegal under SysReg 1314 to put a charge over that asset. So effectively, the only way to do it is either rescind the contract or back it out, sell it out, and then do it all over again. So again, you're up for double stamp duty.
Yeah, absolutely. You know, do you want to bring up that little thing we did, that roadmap, if you got it?
I haven't got that on me. Yeah, I haven't got that. Have you got that on you? Just email it to me and I can do that. Email it, and then what I'll do is let me keep on going, and then I'll wheel back to you if you email it to me, and then we can pick it up. How does that sound?
Yeah, that'll be good. I'm just going to do it right now.
Okay, thanks. So related party financing is really a world unto its own, because the banks have their own process and system. So it means that as an advisor or an accountant, you're really taking control of the whole process. So if something goes wrong, essentially it's on your PI. So you've just got to be extremely careful. And that's what we want to make sure that that doesn't happen. So what I want to look at, some of the key issues is that I'm going to look at a case study. We're going to look at property. So the question is, in some instances, it's great to have transfer of property into an SMSF. And many of you have done that before by utilising, ideally, if there was no limits on non-concessional contributions, then effectively we wouldn't need related party lending. But because we've got limits on what we can put as a non-concessional, we can't just transfer a property in, because any surplus above our non-concessional caps, we need to ensure that effectively that surplus is going to be picked up or absorbed as a related party loan. So the first thing you need to do is just get a piece of paper, work out, what the price is, what the related party loan is, what the non-concessional cap is, and then move from there. Now, the only problem about using property is that if you're going to transfer it in over time, so ultimately, let's say that we've set up a position that we've got $1 million property, it's got a $500,000 related party loan. We've already utilised our caps, but in a couple of years our caps come back on, and we've got another 3 years. Then in 3 years' time, then what we're going to do is another non-concessional contribution to effectively wipe that out. So we reduce our related party loan down to nil if that's possible. So you've just got to be really careful that when you go through that process, that you do have that ability to reduce your related party loan on a continuing basis. Now, it's hard if you're doing it in a lump, like for example, 3-year lump, it's easy. But if you are simply doing it on a small basis, then it can create problems in the fact that if we're just doing 100,000 per annum, and if there's a couple of $200,000 per annum, and then we're holding the property inside and outside, it just changes the percentage. So we're ending up virtually doing a joint venture into that and that party, a bit that's in and a bit that's out. So we've just got to be careful, quite apart if the related party financing doesn't work. So sometimes a 1322C is a lot easier. And particularly when we have a property inside the fund, and we think about it now that particularly with COVID, if there's rental issues or cash not coming through, but we've still got pension money that has to be paid out, how do you cope with that? And effectively you can go through a process of paying out promissory notes as pension payments, and then using those to acquire assets in the fund, such as unit trusts or units in a unit trust. Whereas if you try to do that with percentage of a property, so you might take like 3% of the property, paying it out as a pension payment using a de facto promissory note, it's just going to create all nightmares in terms of doing a joint venture or a partnership agreement. So 1322C trusts have their own issues, but they are good for the liquidity because it's breaking down a big lumpy asset into a small lumpy asset, which we're going to look at a bit later on. So let's have a look at the case study. It's a simple one I've done. If you want to have a really, for those who are strategists or licensees, if you want to have a really detailed look at an LRBA, I did a 2-part series where I pulled apart a very detailed case study. But let's go through this one. So we've got John and Mary are age 60, live in Manly, have an office building. I want to transfer it into a SMSF. So really, there's not a big issue there. Stamp duty, they can use it for retirement purposes. They'll be able to use Section 62A of the Duties Act, and they'll only have to pay $500,000 concessional duty on that one. So that's quite useful. If this was in South Australia, there would be no duty, which is fantastic on all commercial buildings. They own the property outright. It's worth $1 million, and they get $100,000 rent each year from a third party. So that's not a bad income stream, but obviously it's taxable in their hands. That would be much better to be inside an SMSF. And if they can put it into the pension assets, it will be tax-free in the fund and tax-free on the way out. So there's a huge tax saving there, and over a period of 5 to 10 years, the tax savings could, obviously will easily be 6 figures. And again, having gone through the process with my parents is the more money you can save in tax along the way, the longer that income lasts. And particularly when you're trying to get an aged care spot, it's absolutely crucial knowing that you've got that funding there, particularly in this low interest rate environment. So they acquired the property for $600,000 in 2010. So, if you even have a look at a capital gains discount, they've each got a $100,000 capital gain to be added to the current income to date. So this year they're going to have to add $100,000 of capital gain to their assessable income. Ordinarily be $200,000, but we take a 50% discount because they own it jointly. The issue we've got there is that they haven't received any income this year, or this income year ending 30 June 2021, because they've given a rent relief to their tenant, which is not a bad thing. So the first thing I would do anyway, not so much for stamp duty, because the stamp duty is just flat, but certainly if you're in Queensland or Victoria, another jurisdiction where you might be up for stamp duty, I would probably go down and look at revaluing that property, particularly we're in the midst of COVID. Are you there, Michael, at all? Or?
Yeah, Grant.
Yeah, so have you seen many people or many of your clients in the accounting space revaluing properties down as a consequence of COVID?
Yeah, I've had a number of queries coming back from auditors in relation to property valuations, and looking at and requesting more information around that, and obviously with a view of ensuring that it's not overvalued, but I haven't had any that have been valued down to date yet.
Okay, thanks for that. So it's probably not a bad idea to do that, because if we could revalue it down to, say $900,000, then that's going to drop my capital gain down to $75,000 a piece, because we're still going to have to work on that tax-wise. They've got an SMSF which holds $600,000 for each of them. Look, they're age 60, they're retired, they're ready to take a pension, so they've got plenty of capacity to put this property in easily. And obviously want to transfer the property into super. They probably should have done it well and truly before that stage, but some people are just late bloomers. They've not made any non-concessional this year and haven't done 3-year bring forward contributions. So when we have a look at that, and if I do, I'm going to get my little trusty Lightyear Docs pad out, and then I'm going to do it. Although most of you can do this in your head anyway, it's not exactly rocket science stuff. So for each of them, what they've got is $500,000 a pop, which is the value of the asset. Now they've got a 3-year bring forward, so that's $300,000 each, which they can do the 3-year bring forward. So that means that they've got a potential $200,000 loan. But what I'm going to do is I'm going to take a tax deduction of $25,000 for the year ending 30 June 2021. So that will now drop my, if you understand that, that will now drop my $100,000 assessable gain. And remember, we haven't received any rent to date because of COVID. That now drops down my assessable or potentially assessable income from $100,000 down to $75,000. So it means that effectively my contributions, my non-concessional, are 300. My concessional contributions are 25. And then that effectively means that $175,000 each effectively is going to be my loan. So my loan my loan ratio is $350,000, which is 35%. So we're well and truly down that bottom end of the spectrum. So we're going to have a lot of fun with that. Hopefully you've all got that. So I've done my great little figures there. So it's not a bad one. While I'm there, just another one is that we've got 25, we've got another 75 to cover. So I'd be doing a bit of a figure on these guys anyway, because they've got no other assessable income. You find generally at their age, if they've got no other assessable income, that they can put in up to $75,000 as a concessional contribution, and they won't have to pay any income tax personally. But obviously, if we're going to put in quite a bit of concessional, that'll be accessible in the fund as a deductible contribution. But I've done plenty of case studies on that one as well. So we just want to focus in on, at that amount, the $175,000 borrowing, or the $350,000 for both of them. So again, just to paraphrase, they're going to put in the property into the superannuation fund. Inside that, their equity value will be $300,000 of non-concessional contribution plus $25,000 of concessional. And then that will leave us with $175,000, which is above our caps. What we're going to do there is we're going to just treat that as a related party loan. So in toto for both of them, they've got $350,000 as a related party loan going forward. So I'm going to have a look at that. So, so when we have a look at the law, and I'm going to go through and have a look at it, I think the main thing that we need to look at is see what the trust deed allows. So we need to ensure that the trust deed enables the acquisition of assets from related parties. We also need to ensure that it allows the acquisition of, for example, units from related parties or units in a private unit trust. So that needs to be specifically put inside that trust deed, and I'll look at that a little bit later on. We should have a look at potentially whether we can run a business. Here it's not a big issue. But for example, let's say it's a commercial property and then we're going to do a property development on it. We want to make sure that there's a capacity to run a business inside our self-managed superannuation fund. And for that, just, you can go on to the tax office website, just put in there SMSF running a business. You can do that in Google, and you'll pop up with the Commissioner's guidelines on how to run a business inside a self-managed super fund. Again, if you've got that sort of thing, the auditor might say we can't run a business, just hand them the ATO guidelines and just say, look, perhaps you should take this up with the Commissioner of Taxation. The other one is we need to look at transferring those assets in. So the two ways we're going to do that is, if you understand, I can, that property, I can transfer the whole of the property into the superannuation fund, or I could do it with a 1322C trust. At this stage, I probably would just transfer the whole property in rather than a 1322C trust. However, for those people who don't want to go through the related party financing route, if they wanted to do that, so that they've got if they didn't want to go through the related party financing, which I think would be crazy, they'd end up with a property which would be, if you make sense of this, effectively $650,000 would be owned by the trustee of the fund, and $350,000 would be owned individually outside. So you'd have to come up with a partnership or a joint venture agreement between the parties. And then when they come off their 3-year hiatus, or next year if they want to get a tax deductible contribution, you'd have to transfer a further portion into that fund, which makes it pretty ugly. So in those sort of instances, that's when you have a 1322C trust, because that way you'll see when we get to section 66, we can transfer those units in quite easily into the super fund as a contribution. But here we're going to use a related party loan, so I just go straight for the property rather than the 1322C trust. Okay, so let's go through. So if we then go through and have a look at section 66, I'm going to take you through just briefly. Locker versus FCT. Just remember there's anti-avoidance provisions in section 66.5, so you just got to be very careful. In Locke's case, they were a bit scallywaggish. What they did is they got a residential property, then they transferred it into a 1322C or into a unit trust, and they transferred those units over into the self-managed super fund, which all looked okay, but the whole purpose was to get residential property into a self-managed super fund under an arrangement or a scheme which actually breached section 66. Whereas if it's if it's commercial property, it's not an issue anyway, but if it's already inside the 1322C trust, you're okay. So, for example, if a SMSF hasn't got the financial wherewithal to acquire a property itself, and there's a family trust or a bucket company or individuals who want to acquire residential property and then ultimately transfer it into an SMSF, then the best thing to do is put that into a 1322C trust. So the residential property goes in there, the super fund holds units there, the individual family trust or bucket company holds the units, and then they transfer them over to the SMSF by way of a contribution, either non-concessional, deductible, or alternatively can just sell them over to the SMSF. That enables the individual family trust or company can then borrow to finance those units. Obviously with the 1322C, you can't have borrowing in there. So that's just, again, a different way of doing it. Section 67A, in terms of using a related party loan and also refinancing, the big one that's popped up over the years is the utilisation of non-arm's length income in section 295-550 of the Income Tax Assessment Act, which is now been elaborated on and by way of the NALI rules. Now, the issue about NALI is we've got to make sure that we keep within the guidelines of NALI. There's a lot of stuff around about accountants and all that doing their SMSFs, which I don't see as a big issue. When we come to transactional pieces like this, the danger about it is that if an asset, say the property in question here, the commercial property down in Manly, is tagged with NALI, then any income coming into the fund is taxed at 45% plus, and this is a plus, any capital gain, however or whoever so accrued later on, once it's realised, even if it's in the pension side, will be taxed at 45%. So you've just got to be very careful about NALI. The Commissioner's got some great rules on related party financing and NALI under PCG 2016. We'll have a look at I'm going to have a look at the laws, and then I'll come back to the documentation requirements. So let's just bounce out of there. I'll go and have a look at all the trustee laws up there. One of the ones we've got there is obviously the SIS Act. I won't go into any great shakes here. I said there's a couple of very detailed case study workshops on this sitting on the Strategy Centre. I'm not sure what, well, they're basically up there, but if you go and have a look here and you have a look at the Strategy Centre in this instance, so we just bounce into there, webinar videos, which is a great resource for everything inside our system. You'll see there on July the 29th, LRBA strategies, case study, and also part 2, which is on August the 5th. So if you want to know in depth about a really detailed LRBA, go and have a look there. This is more of just a high level situation. So we've got section 66 there, acquisition of assets from members. Obviously there, section 66.2 is the big one. We've got subsection B there. Let me just highlight that there. So I'll just get a little highlighter stuff up there. So if we have a look at it, if the fund is a super fund with fewer than 5 members, the asset is business, real property, the related party acquired at market value, which is okay. So we need to get that market valuation, as Michael said. I honestly, before I did this transaction, I would definitely go and get a proper market valuation, given the fact that we are in COVID. I would have thought there's going to be quite a big impact on valuations at this time, particularly probably 30 June 2020, and then certainly coming up to 30 June 2021. But transferring it in, we must have it at market value. If it's not at market value, then we are breaching Section 66. Just to let you know, you do not want to make a mistake in Section 66, because you as an advisor are also caught under Commonwealth Crimes Act, and the penalties for that is a person who contravenes subsection 1 or 3 commits an offence punishable on conviction by imprisonment for a term not exceeding 1 year. So it's not a fine. Section 66 is actually a financial penalty. Although in Locke's case, they gave them grace. They didn't throw them in jail. They just made the fund non-compliant. The second one is, so that's for the property, but remember, I just want to give it a bit of segue. We're not doing it in this case study. I did do it in those that 2-part, but effectively a 1322C trust going in. So subsection 2A says it doesn't prohibit the acquisition of an asset if here the asset is an in-house asset, which is good. So again, if you've got an in-house asset and the asset's acquired at market value, it doesn't breach the 5% rule when it's acquired. You can actually transfer, for example, things that would ordinarily be in-house assets into a super fund. So that, for example, would be equity in your company. So if you've got equity in the company, the super fund can actually acquire it, but you just got to make sure it's at market value and no more than 5%. So just be careful on that one. The other one is for when we have a look at 1322C. 1322C exempts under Section 71(1)J regulations that exclude in-house assets. So 1322C company or trust are actually excluded. So that means under Section 66 we can transfer those over, which is crazy, because if it's not a 1322C trust, it's just a small unit trust, we can't transfer those units in. So it's a crazy scenario. When we go down to Section 67A, which is the next section, so we're not going to dwell too long on that. I think most of you understand you can't borrow, but Section 67A has some exceptions, limited recourse. So subsection 67 doesn't prohibit a trustee of a regulated fund from borrowing money or maintaining a borrowing money under arrangement. So that includes obviously related party. The money is or has been applied for the acquisition of a single acquirable asset. Again, our trustee needs to make sure that we've got a single acquirable asset. So for that, we can use a collection if we're going to do financing over 1322C trusts. Then effectively what we do is we can use those as a collection as long as they've got all the same rights and entitlements, which generally they'd have. But certainly for business real property, that would be a single acquirable asset. So when we go through that process, it talks about you can borrow for expenses and repairs, but money, including money to refinancing or borrowing, including any accrued interest. Interestingly, as I said before, we had a situation that a client had paid for settlement out of their own name under an LRBA because the mortgagor wasn't ready yet, or the person providing the finance. So we actually had to recharacterise it as a related party loan first, and then the second party being the commercial banker or the financier came in under the refinancing arrangement. So they're basically all sitting there. I won't go into any great detail. Section 295.50, which talks about non-arm's length income. Through our documentation, I'll show you that a little bit later on, but what I wanted to do as part of our pack is we've got the Commissioner's Guidelines, PCG. So this is, you don't go outside this, and this has actually been brought into account under the, it's been brought into account by the Commissioner and the Commission of Taxation in terms of what is required. So I'll go through this, then I'll get Tony on, then I'll actually start to build it for you. So when an SMSF acquires an asset under a limited recourse borrowing arrangement, the non-arm's length income provisions in section 295/550 may apply to ordinary or statutory income. So that's capital gains and ordinary income generated for the asset if the terms of the LRBA are not consistent. The guidelines set out the safe harbour terms on which the SMSF trustees may structure their LRB consistent with an arm's length dealing. That is for income tax compliance purposes. So remember, we're dealing income tax, not super. So this is not an issue that generally goes to audit. It's more of a tax advice. The Commission accepts the LRBA structure in accordance with this guideline is consistent with an arm's length dealing, and the NALI provisions do not apply purely because of the terms of the borrowing arrangement. So this was actually introduced prior to the new NALI legislation that applies from 1st of July 2018. But from that perspective is that new laws actually bring into account this specific statutory guideline, which is important. So as noted, under the date of effect, this guideline applies where the requirements of section 67A, remember I talked about 67(4)A have been met. If trustees have entered into an arrangement which does not meet all of the safe harbour terms set out in the guideline, whilst the trustees are unable to be assured the Commission will accept the arrangement will be consistent with arm's length, it does not mean the arrangement is deemed to not be on arm's length. So what you need to do is find a commercial arrangement around that, and that's quite important, as he says here. It merely means there is no certainty provided in the guideline. The trustees will need to be able to consider, so if I just go, because this is a pretty important one, the trustees will need to be able to otherwise demonstrate the arrangement was entered into and maintained on terms consistent with an arm's length dealing. One example of how a trustee may demonstrate this is by obtaining evidence that shows that a particular arrangement is established and maintained on terms that replicate the terms of a commercial loan that is available in the same circumstances. So that's pretty easy when we're doing property. When you're doing 1322C, you've got some serious problems there. So let's have a look at the first one. Asset acquired is a real property. Again, it's obviously, when we have a look at it, if we're getting it from ourselves, it has to be commercial or alternatively rural. Rural is quite good. So we've got the LRBA here. The guidelines are actually fairly generous for rural, residential, not so, but remember residential we can't transfer in except in limited cases. So the interest rate, the Reserve Bank indicator rate, I think it's you'll see when we get to the guidelines, it's 5.1% at the moment. So 5.1%. So it's come down a little bit over the year. Who knows why it went up so much anyway in 2018-19. So we've either got a choice, we've got a variable rate, which obviously floats, or we can do a fixed rate. So they may choose, but the maximum fixed rate has to be for 5 years in your documentation. When we have a look at the term of the loan, if a variable, it's a 15-year. If you come in and refinance, again, you've got to stick to that original 15-year loan term. One here is useful, maximum 70% LVR for both commercial and also resi property. So that would include a primary production property, which is quite generous because generally commercial, you can only get maybe 60%. And so that means that in that instance, if a bank will only lend 50 or 60%, you can then top it up to 70% LVR with this top up related party loan. Needs a registered mortgage, must be in there. You don't need a personal guarantee. Can be useful, but it's not required. And then you must have P&I payments, and repayments must be monthly there. So, and obviously a written executed loan agreement is required. And how many times I've seen this stuff done by minute? Obviously, it just doesn't work. You don't do, honestly guys, you don't do anything by minutes. Now, the asset is a collection of stock exchange listed shares or units. So that would be, for example, Westfield would include, BHP and all that. I think it's around about 7.1%. We've got so what they do is so it'd have to be 7.1. So it's the 5.1 plus 2%. So there's an extra charge on that for the current year. The maximum loan term is 7 years. If you're doing fixed rate, it's a maximum 3 years, not the 5 years. Again, but the LVR there is 50%. and again, a registered charge or mortgage or similar security. So you'd actually do PPSR as required for that, no personal guarantee. And again, repayments are both principal interest or monthly, and a written and executed loan agreement is required from that process. And looking, go through all of this, the Commissioner goes through, all the guidelines, goes through a whole lot of different options of what to do. But essentially, that's the guts of it. The problem we've got there is 1322C is not listed, so you can't use your safe harbour for that. So what you're going to have to do is either find a commercial lender or potentially just ride through with this safe harbour and just say, look, this is potentially what it is. But there is a danger potentially that it would be non-arm's length. So that's the Commissioner's guidelines, PCG 2016/5, which you want to keep to. And what I'll do is, Tony, are you there? And I will just get up that little thing there. So, okay, so Tony's got a diagram here. Let's just get this up. So what this does is shows the process, setting up a bare trust, setting a setup and bare trust execution for external lendings. Do you just want to go through that one, Tony? And we'll include this as part of the pack for you guys to get when we record that and send it out to you a little bit later on.
Yeah. So easy. Step 1, step 7, step 1 is basically go and find your property. Okay, simple. Okay. Step 2 then goes on putting your offers. Okay, on a table. Step 3, then once the offer has been secured, not the contract of sale, then set up the SMSF structure. Okay.
Just on.
Obviously.
Yeah. Do you want to just go through that process? Because I know where you're going with this is that we do have a number of accountants and even planners, for that matter, who don't want to go through the process of doing a statement of advice, and they're not licensed. So what Tony's doing there is step 3 and step 4, and also step 5. What you can do is Abbott Morley will set up that SMSF for you. You'll then be able to jump in and do all the rest of the stuff up on the Lightyear Docs assistant platform.
All you need to do when you get to that step 3 is just contact me, and all it is basically what I have to go through is have a Zoom conference with the client, make sure that what he's setting up, or in terms of the SMSF, we're going to go through a few questions, and then provide the letter of advice to the client, and then once the client agrees, then I provide a detailed letter of advice in terms of the SMSF structure, and also all the financial planner or the accountant rather has to do from his end is just set up the special purpose company.
Corporate trust, through the Lightyear Docs.
Yeah, yep. That's it. That's all you need, because I've got no access to do that, right? So we need this. All you have to do is that, and then once that's set up with the names and directors and shareholders, etc., then if there's a holding trust involved, you set that up also with a standard constitution, and then you send all that detail to me, and then I take Abbott Morley takes over from there basically and completes the rest of the process. Right, easy. Okay. So the advice is actually coming from Abbott Morley.
Yep.
Okay, exactly. So let's go back to step 3. So once the offer has been accepted or secured, not the contract of sale, obviously, then you set up the SMSF structure. That's where we come in. Step 3 and 4. Okay. And then step 5 is basically set up the corporate structure. We'll take over. We'll set up the SMSF deed. We'll set up basically any LRBA requirements if necessary. Okay. And then step 6 is basically once the bare trust has been drafted. This is important, right? Once the bare trust has been drafted, it is then issued to the lending institution unexecuted for their review.
Absolutely. Okay? You don't get sucked in there. Otherwise, there's $2,000 and giving to Gaydon straight away.
Right. That's right. That's where the key is now. So unexecuted, you forward it on to the lender's institution, will be Gadens, whoever it is, basically. They will review it, and if any amendments need to be done, they will let us know. Okay. If not, and they're happy with the Bare Trust the way it's been drafted, they will give you confirmation and say, okay, it's only then at that stage where you execute the Bare Trust, okay, and the rest of the documentation. All right. So make sure that when you're setting up the Bare Trust, we need to send it to the lender's institution first, unexecuted, for their review first, right? Because what will happen is, if you execute the Bare Trust and all the associated documentation, and then you send it to the lender, and then they come back and say, well, you know, we need this and we need that. Then we have to do a rectification deed, which is a waste of time after.
Exactly. So I think the main thing is, if you're going through any of these sort of transactions, whether you want to do, because sometimes you just don't know whether 1322C or the direct property is best, is to contact us. Probably the best one, we've got the info@abbottmorley.com.au. Is that the best email probably?
Yeah.
Yeah, so just do info@abbottmorley.com.au. Tony will have a look at it and we'll come back. There's no cost on that. We're happy. We're there to look after you. Remember, we are the legal firm for accountants and planners. We don't go out directly out to the market to pick up clients.
Hey, can you just go back to that thing, that step? That's just the last step, basically. That's all.
Step 7.
Then you can take over. Yeah, so unexecuted, comes back, everybody's happy, then you execute the Bare Trust with all the other associated documents that go into play, right? And then once the Bare Trust has been executed, along with any other relevant documents, then, and only then, you execute the contract of sale, not before, right? Otherwise, there'll be double stamps on the transfer after, in the long run. So you've got to be aware of that.
Yeah, you've got to be really careful on that one. So let's just go through. I've only got about 7 minutes. I'll probably go a couple of minutes over because I've actually got to do all this documentation. So Grant's on a bit of a time issue. So what we need to do is a statement of advice required? If you're setting up an SMSF, absolutely. If you're doing a holding trust, a related party loan, generally there's no requirement. That's not effectively it's over property. It's not a financial product. 1322C may be a bit different. Upgrade the deeds, absolutely crucial. So, or set up an SMSF, look at Abbott Morley doing that if you don't want to do an SOA. I'd probably, if you're going to look at upgrading, maybe at least consider using the leading member route for bloodline or control. Clients love that sort of stuff. You're definitely going to have to use an investment strategy, upgrade it, because you're going to take on a bit more of a property there. So make sure you go onto our site and do the investment strategy. Now, the key things there is you must have a trustee meeting to authorise acquiring the property and entering into the related party loan. If you don't have that first meeting, you just go and do a holding trust, then effectively it is what we call ultra vires. It's outside the authority of the trustee. The trustee can't just go and buy a property and put it in a holding trust without having a meeting first to be properly authorised under the trustee. So we want to do that. Then we want to establish a holding trust. Then there also needs to be, the trustee of the holding trust needs to have its own meeting and say that we are going to acquire this single acquirable property. Again, without that process, effectively it is ultra vires. Or ultra vires just means it's against the law for that and can be challenged. Need to do the related party loan agreements, mortgage deed, and potentially the personal guarantee. So I'm just going to jump out of here. I'm going to build it for you quickly. Let me just get the names of our little individuals. So remember, it's John and Mary from Manly. So I've got 5 minutes to build this. So this is going to be a cracker for that. I've got a sample here for you to send. So I'll go to the document categories. Obviously go down to SMSF borrowing, look at the category there. We've got related party borrowing. I'm obviously there as a unlimited document, so I can just simply access as many as I want. I'll go down, put it in Abbott test here. I'll start the product, which then jumps into our system. So the system's up and running. You can see here I'm using Chrome. We did have problems with Chrome, but we've now got a fix there. If you want to find out the fix, then Tony, do you want to just jump on to the questions, have a look at the chat around the sale contract? If we have a look at that, then effectively what we've got there is a position. They're going to put the document in there. So I'm just going to put it Smith LRBA. I'd probably, again, you might want to put your own documentation or your own logo in there, but I'm going to put the Abbott Morley 001, which is the Abbott Morley one. So the superannuation fund, so we've got the Smith Super Fund. I've got a company there. So I've got Smith Nominees, Pty Limited. And then we've got, I'll just put in here, 5 Smith Street, Manly, New South Wales 2094. So I've got 2 directors here. So I just put in 2, pretty easy. I've got old John Smith, tab that, and then I've got Mary Smith. They're both going to sign, so you just want to tick on the box there. We only put those in just in case you've got it overseas. Press on the next. Okay, so the date of the meeting, I'm not sure. I can come in and put it later, but let's say the clients are coming in on the 21st. John and Smith attended. Who's going to be the chair? We'll make it John. We've already got the address, so I'm just going to put in, you can see 5 Smith Street there. Okay, so now I'm going to put in the holding trust details. So I'm going to put Smith Super Holding Trust, or a lot of people like the old Bear Trust. Again, I'm going to make that on the 14th. The trustee is an individual, so I can do that. Because it's a related party loan, we don't need to put in a company for that. So I'm just going to make it. I'll make John Smith is going to be the street. Manly, New South Wales 2094. So, and again, if I wanted to put in Mary as well, I could do that, but I'm just going to leave it as that. Again, I'll make it the 14th is the meeting. John, select autofill, and I've got that then. I mean, isn't it amazing when you have a look at it? So the individual, so what I've got there is I've got John Smith, and we in our new system that we're building, things will be a lot easier because once you've put in an address, it will pop up in your field of addresses. So that's coming up very shortly, probably next year. So that should actually be at another. So there's not another button there. Anyway, so there's an issue there. I'm going to have to fix that up. Also for Mary. So leave that with me. So let's put in the street address. Let's say it's 10 Fairlight Street, and that's in Fairlight, New South Wales 2095. I have to put the portfolio number of the property. So you generally get that off the title. So 456 lot 50. So the consideration for the whole property, remember, was $1 million. The loan amount was 350. So it's well and truly under both the LVR for property and also 1322C, but remember we're doing for property. So 15 years, 5.1, you can see these are the current ones. We're going to do fixed. It's New South Wales. So let me come back and there's obviously joint lenders there. Because I don't want to be doing 2. Then you just need to put in whatever the fee is. I'll just put in, let's say it's $1,100 per month. And there's plenty of calculators out there. Remember, it's a 15 years, it's only 350. What date's the loan agreement going to start? On the 14th. Next, actually, I'll just go back to loan deed. Okay, what date of the mortgage? Okay, so next, And that's it. So that's your whole, what did it take me? There you go. You saw me, guys, 5 minutes. And I'll go in and I'll fix up that particular issue straight after that, so we can do that. So let's just go through. There's the document pack. And I'll shoot you through this as a sample again as I record it. I'll just take you through quickly. So you've got the whole pack. It took me 5 minutes to do. You've got the PCG 2016/5, which would go to the client, which is absolutely crucial because you want to show that everything is in accordance. And plus also, if the auditor says, where's the documentation? Say, well, hold on, here it is, and it's all following the commissioner. So the first thing is that set of minutes. As I said, without this set of minutes, effectively any transaction would be null and void. So we go through the table of motion, acquire an asset, and also a holding trust to establish the holding trust, and also to get a related party loan. So that's all covered in there. So that's your first trustee minutes. The next one is setting up the holding trust, which we've got there. That's been through numerous legal firms. So that's A-OK. But as Tony said, just don't expect that if you're doing this, it'll come back. Then you've got the holding trust property there, all the T's and C's around that. Then we've got the minutes of the holding trust. Remember I said that's the third part of it. That's sitting in there. Then you've got the related party loan agreement. And you've got the trustee is borrowing off there. But as I said, I'll fix this up and make sure there's a joint one there straight after this before I send you out the sample. And then the final one is we've got a mortgage deed. Remember I didn't tick personal guarantees. So effectively we've got a mortgage deed there, and you're essentially off and running. And that's the PCG 2016/5. So that's how easy to do it properly and not make a mistake. Don't be part of that 98 or 99% who do. So let's just go through the final one. Again, I'd like to thank both Michael and also Tony for being part of this. The recording of the session will come out with a sample of the related party documentation and also Tony's 7-step guide on how to do that correctly. And if there's any information that Michael wants to send through, we'll put that in as well. Next Thursday, 24th of September, make sure you watch out for this because I'll be doing advanced healthcare directives for all the other states and territories. 14th of October, keep this in your diary from 9 o'clock to 1 p.m. 9 o'clock to 1 p.m. that morning, we're going to do a full half-day comprehensive estate planning session. So it's free for strategists and licensees, $55 for anyone who's PAYG, and $99 for any other participant. 4 hours CPD and CPE. It'll be an awesome session and will really take your competency up to the next level. For those who didn't get the session, I'd strongly advise, in fact, I'll put a link in. If you missed the session yesterday where I did a real live EPOA and also will on our new sales and BDM, Travis, it was probably the most complex I've done, but watch that. It's a brilliant session. And you can see with the automation how I did that in 5 minutes. Because if you try to pull that all together, it's going to take weeks and cost a lot. So, but again, don't go down the track. If you've got anything before going in and researching, diving headlong, info@abbottmorley.com.au. Tony and I will answer those questions, all part of your subscription. We are here for you. So, gentlemen, thanks a lot for coming along today. And no doubt I will see you, Tony, next week for our advanced healthcare directives. And
Absolutely.
Michael will get you up for that estate planning session as well, because we'll be looking at the protector, etc. for that. So again, thank you very much, Michael, and thank you, Tony.
Thanks, Grant.
Okay, see you guys.
Bye-bye.